Today's episode is brought to you by Stream by AlphaSense, an expert interview transcript library that integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Start your free trial at www.streamrg.co/PMC. That's STREAMRG.co/PMC. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap Podcast. I'm your host, Robert Kraft, and thank you all so much for the support and for tuning in. I wanted to start off today's podcast to honor the untimely passing of Igor Levental. He was an absolute legend in the mining industry with a career that spanned more than 30 years as a board member and holding senior positions with major mining companies such as Homestake Mining Company and International Corona Corporation. From all of us here at Planet MicroCap and on behalf of the Kraft family, we want to express our sincerest condolences and sending lots of love to the Levental family, his wife Jessica, sons Misha and Casey, Misha's wife Evan, and Gennady Levental, Igor's father. Be sure to subscribe to our recently launched Substack, the Planet MicroCap newsletter, for free at microcapnewsletter.substack.com. I'll be sharing all recent podcast episodes from Planet MicroCap and Due Diligence. Plus, every Sunday, I put out our weekly MicroCap wrap to show how the microcap space has performed every week and compared to the broader markets based on data from the MicroCap Review Index. Again, to subscribe for free, go to microcapnewsletter.substack.com. Now, for this episode of the Planet MicroCap Podcast, I spoke with Michael Melby, founder and portfolio manager at Gate City Capital Management. I've met Michael at multiple MicroCapClub Leadership Summits, where I think he's participated in multiple stock pitches at those events. I'd been wanting to chat with Michael for a while now on the pod, and I'm stoked that we can make it happen. Michael is a deep value microcap investor. Simply put, we spend our time breaking down what that means to him and going through some examples that demonstrate that philosophy. Thank you again for tuning in to episode 230 of the Planet MicroCap Podcast, and please enjoy my conversation with Michael Melby. This episode is brought to you by Stream by AlphaSense. You can find them at streamrg.co/PMC. That's STREAMRG.co/PMC. Stream is an expert interview transcript library that is starting to become an integral part to investors' research process. They have a number of interviews on a wide variety of companies, including TMT, consumers, industrials, real estate, and more. Stream provides over 300 expert interviews per week, and 70% of their experts are found exclusively on Stream. Stream is unlike any other transcript libraries. Stream integrates AI-generated call summaries and NLP search technology so their clients can quickly pinpoint the most critical insights. Stream's community of experts and thought leaders partner with Stream to build their professional brands and expand their industry influence. Right now, there are approximately 8,500 plus call transcripts available. For more information, please visit www.streamrg.co/PMC. That's STREAMRG.co/PMC. Welcome back, everyone, to the Planet MicroCap Podcast. I'm your host, Robert Kraft. You can follow me on Twitter at Bobby K. Kraft. That's BOBBYKKRAFT. And joining me today is, this is a long overdue one. I've known Michael for a long time. I've seen him do some stock pitches at various MicroCap Club investor summits. And, I've always wanted to have him on the show. So I'm really excited that we found some time to make it happen. So joining me today is Michael Melby, founder and portfolio manager at Gate City Capital Management. Michael, it's a pleasure, man. Thank you for joining me today.
It's a pleasure to be here. It's nice to say hello again and appreciate the opportunity and the interest. So yeah, thanks for having me on.
Listen, I had to have you on, especially right now. I mean, you sent me your Q2 letter, or your Q1 letter, going over how you performed this last quarter. You're one of the few funds that actually had a positive return, not just a positive return. I think I saw the numbers like about a little over 18%, right? Am I right there?
Yeah, we've feel fortunate that we've delivered a positive return to our investors in the first quarter, and I had a couple positions that performed well for us, and tried to adhere to our investment principles and philosophy, and feel fortunate that at least through Q1, that's resulted in a good result for our investment partners. So yeah, that's right. So feel good about it.
Awesome. Good. See, I caught you at a good time. Now, just so Michael, I want to we'll get into all that a little bit later, but I wanted to dig deeper into your background and where your passion for investing began. So, was it like some of the folks that have been on here where you found that one book and then like I'm into invest, but in all seriousness, love to know where that passion began.
Yeah, and I guess it goes back probably to me growing up. My father was a high school business teacher and taught a general business course at the local high school, and in that course he had a small unit on stock picking, and at that point he had a little contest that I still do today, where he would throw a dart at essentially a Wall Street Journal page and have the rest of the class pick stocks that they thought would outperform for the semester, for the year. And I guess my interest in investing started there, and I guess has expanded over time. I've always been, I guess, more my strengths on the analytical side, and I like digging into the numbers and the accounting and things like that. And I guess combine that with some things that I think are very neat about the public markets and part of capitalism in general is that the work that you're able to do in terms of research or other things to evaluate where the fair value of a company might differ from what the market perceives as fair value, to put that research to work to allocate capital to those ideas. And I think that helps create a system where capital is allocated to areas that are undervalued, and adds a lot of value to people, both businesses over time and ideally to our investors over time. So I think just the interest in investing kind of stems from there, as it's a neat way to combine that work. And in terms of microcap companies, I've always found the space interesting, and I guess started really looking at those types of companies as an undergrad. And I guess coming out of school my senior year, just invested some of the signing bonus I got ahead of the upcoming full-time job in some microcap companies. And I guess there are a couple of things that have drawn my interest to that space. And I think it relates to the idea that from an intellectual curiosity standpoint, you're able to look at a lot of companies that others might not know about. I think that increases the likelihood that someone doing research can add value when there are fewer people looking at it. I think structurally there are a lot of reasons why with microcap companies why that's the case, and you and your listeners are probably familiar with it. But in terms of sell-side research, just a lot less out there. Microcap companies are smaller, so do generate fewer trading commissions generally than larger companies, and do fewer deals generally than larger companies. And from a buy-side standpoint, the amount of the size of companies just limits a lot of the top investors from investing in the space. And so I found that interesting from an intellectual standpoint. It's an area where I think a motivated researcher can add value, and you've seen a number of instances with top investors over time finding value in the space. And one other thing that we like to do is meet with management teams, and have found it a lot easier for senior managers to meet with investors when they're working with smaller companies. And a lot of times you find senior management that's been with the company a long time and might hold a large stake in it. And you can learn a lot just by talking to those groups and understanding their motivations. So a few reasons, I guess, probably segued a little bit there, but hopefully that gives you an idea where the interest started and some of the parts of the microcap space that make it attractive.
Absolutely. I mean, Michael, you gave me so much, so many places to go here. I'm like a kid in a candy store. I don't know where to start first, but I guess my first question for you is, you mentioned how, you basically talk from more of a philosophical level about, some of the reasons why, people end up loving microcaps. But when you were first getting your start in microcaps, I mean, did you read something? Did you see something somewhere and say, oh, there's clearly an advantage as a retail investor, as an individual investor in microcaps, so I'm going to now go look there? Or were you already looking at a few stocks and then realized afterwards, like, oh, well, this clearly, like, why aren't there more people looking at this? And then came to that realization of like, oh, there is a clear advantage that I have here.
Yeah, just looking back, I can't remember the clear delineation on what separated it out. Just kind of talking about the philosophy again, we're deep value investors here, which might be different than a lot of other kind of folks in the microcap space. But I thought a lot of the attributes of deep value investing and at that time too, I think just doing regular screens in terms of valuation screens, a lot of microcap type companies would appear. And I think there are a number of reasons why microcaps should not trade at the same valuation level as large cap companies. And we can go through some of those as well. But just our philosophy, we're value investors and margin of safety investors. And in general, look for companies that we think on a discounted cash flow basis, trade at a significant discount to what the market price is, and also provide a margin of safety where in a liquidation type analysis or environment, and I don't mean kind of a bankruptcy, throw everything out right away, but in an organized process that we look for companies trading very close to what an organized liquidation of the company would yield. And I think from that combination that we limit our potential downside while providing our investors with a significant amount of potential upside. And as looking through it, I think more of those opportunities present themselves the smaller you get in company size. And that's not to say they can occur in mega cap stocks as well, but have found, I think our advantage is finding them in the micro cap space, as they tend to be more apparent and tend to last for a little longer as well. So that's our experience. Overall, we think the investment philosophy of the team can be incorporated into a lot of different areas of the market, but the opportunity set is greatest for us in the microcap space.
I'd like to take a quick second to tell you about this episode's sponsor, Quarter. With Quarter, you get frictionless access to conference calls, investor presentations, transcripts, and earnings reports from markets all around the world, straight from your pocket for no cost. Quarter's mission is to change the way people look at investor relations and create a completely new bridge between companies and stakeholders. The first step on this journey is to let you, the user, interact with the company's content while you're listening. Visit your app store of choice and try it out today by searching for Quarter, and that's Quartr. Now back to the show. So take me back to when you first started investing in microcap stocks. You said you took your first signing bonus and you put it in a few stocks. What was your strategy at the time? What was it that got you hooked? I mean, you can name the names if you want that you first got active in, but love to hear. Take me back to that time frame, and then of course how that evolved over time.
Yeah, I might just kind of give you my career path as well, and that might frame kind of the interest in philosophy as well. But went to undergrad, majored in finance at Notre Dame, graduated in 2003, and then went to work at Deutsche Bank in their debt capital markets group. So not an equity background originally, but I think it gave me a good background in fixed income markets and then also financial derivatives. And interestingly, we look for companies that are usually unlevered with very little debt, and also companies that we don't short anything, we don't use any leverage. And I think what that experience provided was an aversion to those types of instruments, and seeing, especially in the 2008, 2009 timeframe, how those got a lot of people into trouble. Then I went to work at the Notre Dame Investment Office, was there from 2007 through 2009, focused on fixed income risk management and natural resources. Left there in 2009 to get my MBA at the University of Chicago, and graduated in 2011. And at that time formed the entity, which is Gate City Capital Partners, and put together a portfolio of microcap value companies. And after that, worked as a long-only research analyst for about 3 years at a firm called Crystal Rock Capital, and left in June of 2014 to launch Gate City Capital to outside investors. It's been my full focus on it. In terms of, I guess, going back to college, kind of the initial focus, I don't think there are any kind of good case studies that came out of that. I think it was more of a focus on the attributes of the space, and I think that only grew. And some early, I guess, companies I invested in included Barnes and Noble at the time, and predecessor to Service Corporation on the funeral side, or the cemetery and funeral home side. So Barnes and Noble, interesting one, and they had a spinoff or two after that as well, which I think could be interesting. But in any event, look for companies that have good free cash flow yields, good balance sheets, and that's extended over time as I continue my career. Also decided to branch off on my own.
So what ultimately led to your wanting to then go full time with Gate City Capital Management in 2014?
Yeah, I think there are a few things. When I launched it, it was subscale and essentially my own capital, and then capital from 3 or 4 friends. It was under right around $500,000 in size when it was launched, and so not of scale. And when I talk to other investors who are considering the path, I think there are 2 important things to consider when launching your own firm. And one is to have a strategy or an investment process that you think is superior to anything else out there. And it's not meant to be said in a boastful way, but if you don't have that conviction in the process that you've developed, and you're going to go out and market your strategy to your friends, family, and outsiders, if you don't have something that you think can provide value for them more than what is already out there, then what is the point of what you're doing? There are a lot of different ways to be a successful investor, and everyone's strengths and weaknesses are different. I think it's important, and what I thought I had at that time was an investment philosophy and process that was different than almost everything else out there. Concentrated portfolio of microcap value companies, long-term investors, and not really a scalable strategy, which I think has thrown a lot of people off that would like to do something similar. And so I thought that process, combined with a deep research-focused process, including company visits, was something that could add value for a long time for our investors. And so in addition to having something that, an area where I thought I had a sustainable competitive advantage, the other aspect is from a finance or economic side, being comfortable with a stream of income that is going to be much more volatile. And early on, for me anyhow, not something that was sustainable from a business model standpoint, or that had to grow a fair amount. So what I wanted before starting off was both the vast majority of my net worth invested in Gate City, and also to have reserves of cash on the side to both manage the expenses of running a fund and my own personal expenses for a period of 3+ years. And I wanted to take away all the motivation of accepting capital that wasn't a good fit for me long term and for our other investment partners long term, and also remove, to the extent possible, the pressure to deliver monthly returns or short-term performance. And so I felt that 3 years was appropriate for to indicate to others that it's a long enough time frame where the success of the strategy could be observed by outsiders. And it was also a period where I thought after that period of time, through word of mouth, through a regular internal marketing program, that I could build a list of investment partners, or a pool of assets essentially that would be long-term in nature, that would match the duration of our investments, and serve as a great long-term pool of capital to enact the strategy. And I think those aspects are important, and highlight to others that the pressures and stresses of managing something where the vast majority of your wealth is, where your close friends and potentially family wealth is invested alongside of you, that if you don't have those two aspects, if you're not comfortable with them up front, it can be much more challenging, and you're much more prone to chase returns or chase strategies where you might not have a competitive advantage. So those are the two things that I was comfortable with in 2014. And when I talk to others, encourage them to be comfortable with before looking to go out on their own.
I mean, that's a really different approach, right? Basically, I don't want to say putting a cap, but I mean, you're probably not actively out there raising capital for your fund, because you're always like, look, no, this is where I'm comfortable being, so that I can continue to execute on the strategy that I want to do. What happens? I mean, listen, I think in your Q1 22, you've had over 800% net annualized returns since you launched in 2011. So what do you do if you keep performing well? I mean, how do you manage all of that? As the assets continue to grow.
Yeah, it's a good. There are worse problems to have, and we feel fortunate that I'm currently facing that problem. And I guess just to kind of go into and to expand on our team here as well. But I've been fortunate over time. I started off, it was just myself from 2014, and had some very good interns during the time. But basically hired our first full-time employee partner for me, Nick Bodner, in early 2017. And then Chad Kohorst in August of 2017, and he served as our CFO, COO, and has also helped out on the research side. And Nick's been focused full time on research. He is part of MicroCap Club as well, and was a big contributor on Seeking Alpha before joining us here. And more recently, Harry Sowers just joined earlier this week the team. So from a growth standpoint, then feel fortunate that with more assets, I had the ability to bring on some great long-term partners. In terms of size, I'll just talk at a high level. We've agreed not to grow to a size of over 150 million in assets, and the problem comes along. I'm not going to kind of give our asset value here, but should performance continue to be positive going forward, we will have decisions to make in terms of keeping the fund at a size that we think provides the best absolute returns for our investors, and manage that against with performance growth that can put those two into conflict. And so looking for the best ways and thinking through that in the future, the best ways to manage that in terms of providing our investors with the best opportunities, while also being cognizant that they might want to grow with the fund's growth. So trying to balance those things as we think about going forward, and in a way that allows us to continue to enact our strategy and ideally deliver positive absolute returns for our investors over a long period of time.
Got it. I like how you started off that answer. Like, hey man, there's worse problems to have, right? I mean,
Yeah, and to your point, a lot of the largest, a lot of value investors started in the microcap space and have evolved over time. We think some of the attributes I mentioned before in terms of our investment process adhere best to the microcap space and provide us with the best opportunities to deliver good returns over time. And that it's a balancing act. As the larger you get, the more difficult it is to both build positions and more difficult it is to close out of positions. And also limits just purely the size of companies that are appropriate for your fund. And so
Right.
I want to maintain as much flexibility as we can there and stay focused on what we do best. So kind of when the time comes, we'll have some, I won't say difficult, but important decisions to make in terms of balancing those two aspects.
For sure. And listen, I very much appreciate that, because, I've been doing the podcast long enough where, I've had a few folks on here who, started off as individual investors. They started their fund and now they've performed. So I like Connor, is, first one that comes to mind. Right. So it's really cool and interesting to see that growth and then how you're now going to put together a strategy of like, okay, we're growing a lot. We need to kind of figure out what we're going to do here. So it's, I hope for you and the firm's sake that you continue to have to deal with this problem.
Thank you.
So, all right, let's dig into your microcap evaluation strategy. As you said, you're more on the deep value side, so you mentioned a few of the metrics and some of the things that you look for just at the outset. So I'd love to maybe kind of get a full picture of what those things are. And then what are some of your next steps are as you're, okay, we're going to start, do a starter position, build that portfolio, build that position. So love to hear that strategy there.
Yeah, happy to. And we'll try to address everything you talked about there. But if I get sidetracked, revert me back. But it starts with idea generation. And we like to say that our best idea generation is companies we've already looked at. So we have a database of 250 to 350 companies, and most of those we've taken notes on. A lot of them we've had management meetings with and have come. We do, I guess, as we go through our diligence process, we produce full models across income statements, balance sheets, cash flows that produce a DCF analysis where we come up with what we think both the intrinsic value and then also the floor value of each company. And we maintain those in a database and observe them over time. And they become more or less attractive depending on what the price does and maybe depending on how the company executes or any changes to intrinsic value that we see over time based on factors either in their industry or in the broader market. And so when looking at a company, we want at least 50% upside, 50, calculate on a DCF analysis. And I can go into that a little bit as well, but then also minimal downside. And but there are a lot of companies that we might not have looked at. So on a weekly basis, we do 3 screens. One is a 52-week low screen. One is an enterprise value to EBITDA screen. and one is a market cap to property, plant, and equipment screen. And so they might be apparent, but except for the last one, the first one is designed to find companies that are currently performing badly, that there might be forced selling or other things that have driven the price down. The second one is a general valuation screen, where we're looking for companies trading at a low multiple of EBITDA, which we then translate into free cash flow. The third one is for companies that have invested, ideally cyclical companies that have invested a lot of capital in the past and are not getting a return on that capital today. With the idea that in a cyclical market, if they have made relatively good investments over time, that cyclicality should reverse at some point. So those are kind of the weekly screens, and when something comes up that catches our interest, we'll then start the due diligence process. We also we follow a lot of the information on public sites. Nick has a very strong Seeking Alpha network, and things like MicroCapClub and Value Investing Club, where ideas of others that look attractive, that we're able to observe those and then do our own work on them. Then we have a list of, investors that we exchange ideas with over time, and try to be open to others, young and old, that might have ideas that seem interesting. In our process, if something looks interesting, we go through the financial statements and the publicly available information, go through the proxy and try to understand the incentives of management and the incentives of the board. If the company has transcripts, go through that and any prior investor presentations, and try to do the same for the industry as well, and understand what drives cash flow and how competitive the industry is, the advantages or disadvantages the company might have. And then we normally create a model. We fill it in by hand. It's time consuming, but we want to be sure of the financials. It's interesting to observe how different metrics have changed over time. And a lot of times companies put things in the footnotes that might not be apparent, we think, to investors that simply do a download process. And we want to be responsible for all that information and know what's in it. So spend a fair amount of time on that, and it's created what I think is a substantial asset for our company, having north of 250 companies modeled out. And those aren't all up to date every quarter, but creates a system where if something becomes interesting later, that we can update it in pretty short order. After creating that, we normally reach out to company management and look to see if we can set up around a 45-minute call just to get to know them, understand the cash characteristics of the business, how they make money, and expand on the competitive nature of the business. And depending on how the call goes, then we'll look to set up probably an in-person meeting. And we've had especially pre-COVID, we had a requirement that before making an investment, we want to meet with company management, ideally at their place of business. And we're not experts on operations or anything like that, but we think we get a lot more information and understanding how to meet people in person than we do over the phone or through other means. And that also gives us a chance to see how the office is, to see how, if they have a plant there, to see how things are set up. And again, even though we're not experts on how things should work, you get a pretty good idea of how employees act, the equipment, how things are taken care of. And in that meeting, I guess there is a counter argument, and I get it in terms of in-person meetings, that management is promotional. They'll tell you what you want to hear, and that they're motivated not to be biased, I guess. And we agree with that. And in a trip we make, I mean, you could read a lot of annual reports in that time. And the argument I have, or I guess the philosophy, is that especially in microcaps where management can have an outsized impact on how the company does. Meeting that individual or individuals in person is very important. And we tend to look for three things: intelligence, work ethic, and integrity. And usually have myself and at least one or two other of our partners. And for the most part, we come to the same general conclusion on those three. There can be differences, but we tend to try to avoid people that are overly promotional, and think we are fairly good at identifying the integrity aspect as well. Not to say we're perfect there, but we think that meeting and getting some different perspectives on each individual is helpful. So after that, we use any information there to refine what we think the company's worth, both on an upside and downside basis. And I should highlight as well, while it can be helpful to understand what the upside is, that the in-person meetings is really helpful in determining our downside. And we base a lot of that on either current assets, cash, receivables, inventory, but also on the value of properties. And seeing things in person, there are situations, and maybe I won't name names here, but where in-person meetings indicate that the assets that we thought should be in place are not in the quality or in the state that we were hoping for, which can be a big reduction in what we think liquidation or that type of value is for companies. So once we have, for each of our portfolio companies and each company that's close on our watch list, we have both our price target, which is based on a Dcf analysis, and the downside. We compare that on an absolute basis. So we'll take potential upside, say it's 50%, and potential downside, say that's 10%. That's a 5-to-1 ratio, and we force rank the portfolio companies in all possible targets based on that ratio. And it might be a simplistic way to do it, and ideally the odds of reaching intrinsic value are a lot higher than falling to the liquidation value. But we think, I think in general, people are overly optimistic about the companies they look at, and I think provides us with a way to really focus on the downside there as well. Based on that, we'll size the portfolio. There are constraints in terms of liquidity and other things, but we look to have it so our companies with the highest upside versus downside ratios are the highest weightings in the portfolio. We target around 15 companies. We will go up to 20% in any one individual company. If we're up that high, we look to have situations where we think downside is very, very limited. I guess after, I'll talk a little bit about our DCF analysis. I recognize that the critiques of that versus other valuation metrics, and the garbage in, garbage out possibilities there. It's my philosophy that a company is only worth what cash it's able to generate, and that's what the value should be. And in terms of relative value, try to have the mentality that we're owning the company. And we're owning it for the long term, and we're not owning it to sell it to someone when their mentality might change. And trying to predict other investors' sentiment in terms of buying or selling assets at different points in time, all the different motivations that they have, I think is very difficult. And so we apply generally a 12.5% discount rate that hasn't changed. It doesn't change regardless of when interest rates go up or down, as I think that in general is the return I want for a microcap type company. We can bring that up for companies that might have other risks that we think would raise the return requirements that we would have. But then try to project out what we think normalized profit is when they get there, and pay close attention to taxes, and think about the return requirements from a cash standpoint if we were to own the business, what we'd want to have. And it's created a situation where a lot of our companies have cash flows that where not necessarily a lot of their cash flows are in the terminal value. And so look for companies that provide payback periods in a relatively short period of time. And I think using a relatively high discount rate reduces the risk that you're waiting all your cash flows in the very out years. But that's kind of the valuation process. And I guess one other thing in our process that we do, we tend to go to annual meetings, and a lot of those have gotten virtual during the pandemic, and rightfully so. But we found it valuable to meet with usually the entire management team there, and at least in prior times, the entire board of directors is there. I think if we establish Gate City as a long-term investor, one that's done work, one that cares about the outcome of the company, and I think that's helped in terms of building our relationships both with management and with the board. And I think those can be very valuable in the years to come. I hopefully touched on a lot, but probably missed a few too, and maybe created some additional questions. So I'll pause there.
Well, no, that was great. So thank you for that complete overview. How many new ideas do you tend to open in any given year? I mean, I'm sure it depends, depending on the time frame. But how often are you adding new ideas to the portfolio?
Yeah, our average full timer turnover is a little under every 2 years. So our turnover is 0.45 or 0.5 or so. So our average holding period is right around 2 years. We might add 1 or 2 ideas a quarter is probably on average the pace of adding.
And I mean, what's been interesting? Let's say in the last 2 years, since COVID started, I'm not asking for individual names, of course, but what have, now that everything transitioned from how you used to do things where, you go visit, and yeah, things are opening up a bit now, but it's not like you were sitting on your hands during those 2 years. So what has that experience been like? And then what's been interesting to you over the last 2.5 years?
Yeah, especially early in COVID and recognizing it's a very, very bad time for people throughout the world. It was challenging, as you mentioned. A lot of the way we had done things had to be put on hold for a while, and I think it was one spot where I critiqued kind of our internal process as well. But in general, our thought was that we still want to invest for the next 3 to 5 years. That while very difficult to tell how long the pandemic would go on, that things would end eventually. And we wanted to maintain our investment approach. And we did relatively, and maybe where I would have changed things a little bit, we did relatively little short-term, maybe I won't refer to it as short-term, but in terms of COVID beneficiaries and the companies that would benefit from COVID, we took a longer term view and kind of said things would get back to normal eventually, and we'd want to own companies that we think on a normalized cash flow basis would do well over the long term. So I guess just going back, and we didn't change a whole lot. Just based on our metrics or our criteria that I mentioned before, it's probably worth noting some of the things that go along with that. But most of our companies have and continue to own some sort of real asset. So that's included land, buildings, property, and equipment. And we find that valuable for a few reasons, and they tend to be old economy type businesses as well. But we like that from an idea where you're not dealing with variable costs, where you control your own destiny with a lot of your assets. And from an inflationary standpoint, it's been an area that I've had concern about for a long time. It's in the news a lot today. But having assets that should go up in value along with inflation, that is a very valuable, for lack of better words, hedge against a bad or an inflationary type environment. We also look for companies with very little debt. So the vast majority of our companies are net cash. And if a company does have debt, we have 2 simple rules that we want to apply to them, and that is that they have the ability and willingness to pay off that debt. So there are a lot of leverage ratios that are thrown out there, and I'm generally shy away from those types of situations, especially with microcap companies. And it might go back to kind of my debt capital markets days, but it's very tough to raise money when you can't, when the market's bad. And that can create a lot of refinancing risk, and in addition to the operating risk that the company's going through in that bad environment. So from a margin of safety standpoint, try to avoid that leverage or refinancing risk by avoiding leverage of companies that can't pay off their debt. And I think those two rules are good for not companies, but people and governments and everything else, and it's not always applied to. But the other thing, we try to keep things generally simple in terms of industries. We're agnostic, but tend to avoid tech companies over time, as they generally don't have the real asset component. They can have a lot of cash, which can provide a margin of safety. It's not what I'm best at, but there are instances where we'll look at it. We tend to avoid financials just from a debt standpoint. Their business models tend to involve leverage, and it's very tough from an asset standpoint. When a lot of those assets, for instance, in a bank are loans, or with an insurance company might be investments, what they're actually invested in. And so I guess coming out of or in the midst of the pandemic, we did a lot of work on companies that we thought would be around for a while, that had owned assets that we thought were valuable, and companies in a lot of cases that we thought were negatively impacted by COVID-19 and the pandemic. And so it's interesting. I think going back to kind of my initial comments and having conviction in your investment process, early on in 2020, the strategy that we did not perform well. And so you had a lot of companies, either on the tech side or other companies that might have their business models improved by having people stay at home. Those weren't the companies we owned. And so we lagged for a fair amount of 2020 and stuck to, I guess, our thoughts and our process, where we wanted to own companies that with a margin of safety, with limited debt, in industries we understand, and invest for the long term. And I think sticking to that philosophy, while it wasn't the best in kind of the first half or even the first three quarters of 2020, helped us do well later in the year and then through 2021 and early 2022. So try not to change much, and hopefully we're on the way to where our diligence process, or the one we've enacted historically, can be returned to. And the macro environment's obviously changed here as well, but no big changes in terms of the companies we invest in or our style or approach as we entered a potentially more challenging time in the market.
Sure. Hey, Michael, another thing I'm noticing, looking at, you sent me your investor deck, and, you have a few case studies in here. And also in there, you mentioned that it seems like you like asset heavy businesses, right? Physical asset heavy business. Am I off? Am I right there?
That's right. And it goes back to kind of the margin of safety aspect. And also the idea that over time, a lot of those things should appreciate in value. It's not saying it will, but we think it provides a nice inflationary hedge, and it's generally, to make the decision to buy versus rent something is a decision I think people generally don't take lightly, and it indicates a level of conviction, at least on management standpoint, that an investment should be made and is one to own for the long term. So yeah, that's right.
Yeah, no, I bring it up because, here you are sticking to your knitting with, we like asset heavy versus, some of these tech SaaS names that just, went nuts during, once everything kind of took back off in 2020. So that must have been an interesting time where you guys were probably looking yourselves in the mirror of like, okay, Where are we sure? Are we sure this is where we want to continue going down?
Yeah, it's interesting, and I think technological innovation has made people's lives a whole lot better, and being able to invest in that is very rewarding, and it's improved a lot of lives. That being said, it's probably not the area that I think I can add the most value to, and there are other investors out there that are better than that, better than I am at recognizing new ideas and new trends and things like that. But I think overall that the rotation that seemed to be apparent to me, and at least from 2017 through 2020, of a rotation into asset-light businesses, and I recognize the return on capital can be very, very good there, but also recognize that economic environments can be much worse than the periods they were from 2017 through 2020, or pick whatever time frame you want. And during those bad periods, we want to have the longevity that we can be around for a long time, and the operating leverage of low capital intensity businesses works both ways as well. So I think overall we try to pick companies that we think have the staying power to be there for a long time, and physical assets provide some additional assurances for me that won't take place.
So now what you're trying to tell me is that, now you're actually looking at asset-light businesses as they become out of favor, of course, right? Like that, clearly.
It's something we talked about a lot more, and I don't think we're there to make that rotation yet, but I think it's something we're keeping an eye on, especially as companies with very strong competitive advantages there, good cash balances, and strong balance sheets start to trade at free cash flow multiples that are similar to companies that we've historically looked at. So we've had those conversations internally.
Very good. So take me back to an investing experience, either prior to founding Gate City or even, since founding it, that would you say, either changed your career the most, or, proved like, okay, this is how I want to invest, or like, oh, this is how I definitely do not want to invest in microcaps?
Yeah. I guess a name we've owned for quite a while, and one we continue to own, is a company called AMREP Corporation. And the ticker there is AXR. And it's just as a background, they're large landowners. They own 18,000 acres of land in a city called Rio Rancho, New Mexico. They've owned it for a long time. The company essentially founded the town back in the late 70s and early 80s. And it does a fairly good job of showing the companies we look at. Early on, the company always owned assets there. They had their own kind of publishing media business early on with certain buildings and assets in Florida, and they also have several assets in Colorado, including a residential development in a town called Brighton, Colorado, which is a suburb of Denver, and they had some commercial land in a suburb called Parker, Colorado. And so I think it kind of highlights the process we did. Initially, I had a conversation with the CFO, later set up visits to meet with the company and see the land in Rio Rancho, and I made a number of trips there over time. And over time, it built a sizable position. We were one of the top holders. And I think, just from a land standpoint, did a lot of work in evaluating the company's land position, the optionality available with it, and trying to do a lot of work just in Rio Rancho. So I met with city officials and different developers and different home builders and things like that to try to understand the market. And in general, the view was that the land ownership is the land ownership they held should be a significant store of value, and the ability to monetize that is cyclical in nature depending on the housing market. So sold a whole lot of land in call it 2005, 2006, 2007, and then not very much land from 2009 through, call it 2015. But essentially what the company does is they're a land developer, and they've expanded into home building operations as well. But they'll take raw land, get it permitted, develop that, put in the curbs and gutters, and sell it to home builders. And based on I guess our team's visits to the city, it's not a ghost town. It's a very business friendly area of New Mexico. We saw a lot of potential growth and a lot of people moving there. It's a close suburb of Albuquerque. Albuquerque's about 15 minutes away, and Santa Fe is about 50 minutes away. Rio Rancho is a city of about 100,000 people. So based on that, the company had a new president and eventually CEO come in, and we thought his process of allocating capital was good, and a big improvement of what had been there before. We thought there were improvements in the board of directors, and I guess during the onset of COVID, the stock fell pretty sharply. At one point was traded down to $4.50. At the time, it was a 32 million market cap. They probably had 10 million of net cash, and we got 18,000 acres of land. And so we increased the position fairly substantially then, and it took some time, but it later became pretty apparent that the housing market would be a big beneficiary of a low interest rate environment where people were working from home and looking to relocate from large, expensive cities to more affordable areas. And the company was also able to monetize some valuable buildings they had in Florida. They sold off their media business and were able to generate a large amount of cash. And since that time, the company's repurchased probably 40% of their outstanding stock, still maintain a very strong balance sheet, and have been able to do some development work in commercial properties while taking very low risks that we think has really increased the value of it. Stock doesn't trade that much, but current value, it's about a 65 million market cap, a 65 million enterprise value. We think on a run rate basis, they can, in a normalized housing environment, they can generate free cash flow north of $6 million a year on kind of a run rate basis, with the opportunity to monetize certain commercial parcels in much bigger size in a time period that we're not able to predict, but they can bring in much more sizable cash flows than what the run rate for housing is. We think they'll be good allocators of capital. They're conservative, and it's been a nice success story for us. Has provided a good return for our investors. So overall, it fits the mold. Clean balance sheet, where the company used any cash flow to pay down outstanding debt and build the cash balance, and then reallocate that to repurchasing stock. A margin of safety, we think the land's not going anywhere, that it will appreciate in value over time, and provide a chance to monetize that as well. And in the event there is a downturn, the value of the land will fall, at least temporarily, as there are less development opportunities available. But with cyclicality, that will change over time as well, and we're able to think long term and do cyclicality. It's an overview of a company that is somewhat typical for us.
Gotcha. All right. Well, we're pretty much. Well, firstly, thank you for that, and again, thank you for everything that you.
I forgot my disclaimer there as well, but I don't recommend that to anyone that's and our positions change. We do currently own Amper right now, but all investors should do their own work and their own diligence, and we don't make any recommendations. But hopefully, that can be one part of the information people utilize when making their own investment decisions.
Very good. Everyone's compliance is going to be so happy with that. Perfect.
As they should be.
Yes. So, to close this out here today, because, you've given us so much. What advice would you have for new investors that are looking at microcap stocks right now?
Yeah. I guess I go back and say everyone's different, and everyone has different expertise and different abilities and skills and weaknesses. And for early investors, I'd listen to what a whole lot of people have to say. And there are parts that'll resonate and parts that don't make sense. And with the goal, if you're an early investor, of finding out what type of investor you are and what your individual strengths and weaknesses are. I think listening to others can really help someone determine what type of investor they are, and then to be true to that. While you can list any number of investors historically that have done amazing, that they're not you. And to take what success stories they have that apply to you and utilize that, and think about where they haven't done well and try to utilize that as well. So I'd be open and try to formulate your ideas of how you want to invest for the long term based on your own strengths and weaknesses. In terms of the current market, I think it's anyone's guess where things go from here. We tend to be fairly conservative in nature, and I think everyone knows the headlines out there in terms of inflation and other things. We continue. We've taken a pretty conservative path through this, and would focus on companies again with clean balance sheets, and be aware that things can change very quickly, and take a long-term approach in terms of companies you want to own for the long term, and find those companies at a price that you think provides a good amount of upside over the long term, with something you're comfortable with owning at that price, not just for a few months, but for the long term. So we think the current environment should present opportunities, but would be patient in the current environment too, as we think there are probably some bad things yet.
And that's a great place to end it. Michael, where can our audience go and find more information about you, Gate City Capital Management? I don't think you're on social media, but hey, if you happen to have some handles, plug away.
Yeah, I'm not active there. I just we tend to be pretty private in terms of a firm, but I'm happy to talk to anyone. We have a website, gatecitycap.com. There you can find an email address, info@gatecitycap.com. That'll all go to me. I'm happy to interact in terms of ideas that people have, or if they just want to ask questions. I do take calls, I answer the phone, and respond to emails. So any people can reach out to me there, or there are phone numbers there as well. And look forward to helping with any questions or comments that people might have, and always interested in expanding the, for lack of a better word, the network I have, and the individuals that I can talk to and share good ideas with. So very open to talking, and anyone that wants to reach out, you can send me an email or give me a call.
Very good. Well, Michael, thank you so much for joining me today. I really do appreciate it. Good luck. Stay safe. I look forward to our next update.
I enjoyed it. Thanks for having me.
Thank you. This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap Podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.